Beautiful. All right, go ahead.
All right, take the floor.
So pretty much the idea is I'm front loading my depreciation. I'm not giving you guys any more depreciation than you would have had otherwise. I'm just helping you take that depreciation faster. So for the most part, your average real estate investor, your typical real estate investor, unless the properties are old, you should have sufficient interest and depreciation expense to offset any income, right? You buy a property, you take a loan out on the property, your interest is deductible, your depreciation is deductible. Typically, where our service comes into play is where you have investors that invest in deals. They've got income from somewhere else, and they want to use their real estate to offset their tax liability from other income. That's usually the play. Or they have properties that are fully in the green. They don't have sufficient interest and depreciation expense, so then they'll buy other properties to utilize that depreciation to offset their income. The caveat is that in order to be able to use the depreciation, you have to be a real estate professional. If you're not a real estate professional, or either real estate professional or have other passive income to offset these generated losses, the losses are going to get suspended as passive activity losses. So we want to make sure that when getting into a deal and you're getting into the deal for depreciation, that your investors can actually utilize that depreciation and, excuse me, they're not just going to get stuck as passive activity losses. The exceptions to passive activity rules are going to be a short-term rental and Airbnb. If it's a business use property. So let's say I purchase Amazon, I've got an Amazon warehouse. I'm selling something on Amazon. I purchased a warehouse for my building. So then
Oh,
I
oh,
could
hold
utilize
on one
that
second.
I could utilize that income to I could utilize those losses to offset business income. So real estate professional, business use property, or a short-term rental, which is also in essence a business use property. Um, you'll front load the depreciation. You'll utilize that to offset income in the current tax year. The net effect is that you're going to have less depreciation in future years. So if I front load all my depreciation and I take the bonus depreciation in, let's say, 2025, then I'm going to have less depreciation in later years. That's always one thing to take into consideration. Second point is when you sell this property, if I sell this property for cash, there's going to be a depreciation recapture. So whatever depreciation I took, I have to pay that back. So the example I always give is if you buy a property for $1 million, now you sell it for $2 million, you've depreciated it down to zero. So from zero to $1 million, you're going to pay depreciation recapture rates. And then from 1 million to 2 million on that, you're going to pay your long-term capital gains tax rates. But there's always depreciation recapture. Like you said, there's no free lunch from Uncle Sam. Of course, if you do a 1031 exchange, then you just roll over a lower basis into the next property, and you're not going to pay any immediate depreciation recapture. So that's really the long and short of it. That's pretty much the service. It works. It's beneficial so long as you meet the criteria and qualify.
Right. Quick question from me. So it's not going to be beneficial for people who have straight income from W-2. They
If it's
have,
just W-2 and then they're getting into syndication deal, more often than not, it's not beneficial. Again, I always tell everybody, confirm with your CPA, find out what does work and what doesn't work. But based on my experience, although it's sold that it could work and it might work, very often, if you're a syndicator, you're a passive investor. Now, somebody can have 1,000 passive investments, and some of them are very profitable and they're generating income, then they could use the cost seg study. But often, if you're just an investor and a passive investor in a syndicated deal, that depreciation is not going to do for you what you think it's going to do for you. Does that
ma-
make sense?
makes sense. Can you walk us through the simple, let's say, LP who's going to put like $50,000 before end of this year? We purchased property in November, so we have 2 months left, which is will indicate the paper loss for 2025. How that 50,000 will work for that in LP?
So it depends on the property, but whatever whatever the $50,000 investor's ownership percentage is of that property, I'll send you an estimate of the property, and then you'll multiply the investor's ownership percentage by the total depreciation available, and then that's how much depreciation they'll be able to pull out of a property. So, I mean, do the math, right? If somebody's a 10% owner in a deal and there's $1 million of depreciation available from that deal, then they'll be able to walk away with $100,000 depreciation expense in that current tax year.
Okay. All right. So, and how that depreciation works in the terms of numbers. So it's been split it like on three different categories: 5 years, 7.5, and 27.5. So
So,
it's all partially taken from each category and put it together, or it's been accelerated on one
so
time.
it depends on the property. It depends. every property is different, but let's say like your typical, your standard garden style property. There's going to be 5-year property, 15-year property, and then 27.5-year property. Your 5-year property is anything on the interior of the asset. Your 15-year property is anything on the exterior of the asset. And then your structural component is going to be your 27.5-year property. So depending on the property, I would say you're call it a multifamily, garden style multifamily, vintage, 1970s, had renovation work completed to it. So you've got new kitchens, new appliances, new flooring. I would say just high level, back a napkin without looking at the property. I would say probably about a 22% reclass to 5-year property and probably about an 11% reclass to 15-year property. So, somewhere in there within range, say between 30 and 33% reclass. And again, that's without looking at anything. Don't hold me to it. I know I'm being recorded. So wherever this ends up, be careful, guys.
I
But
know, I know, I know. I know. We're not gonna bring you to the court based on our.
that's just general. You give me a city property where the building comes straight up to the street line. I'm not going to get you there's no parking spots, there's no landscaping, so I'll get you everything on the interior. If it's an older New York City building, I'm not getting you any flooring either because it's hardwood flooring that's nailed into the ground. So I'm not going to get anything either. But for the most part, that's the concept. 5-year property, 15-year property, and then the rest of it's going to go structural.
Okay. So, but it's all accumulated each year, and it makes more sense to hold it for more than 5-6 years, or it's all will be equalizing after 6 years of holding.
Well, it only makes sense to do the cost seg study if you're going to be holding it, more than a couple of years. If you're just getting in and out, then you're going to pay my fee, and then you're going to get hit with immediate depreciation recapture. If you're holding it, I like to tell clients more than 4 or 5 years, then it's worthwhile to do the cost seg study. That being said, I never know my clients, full reasons why they're doing a cost seg study. Perhaps they have a large tax liability and they just want to kick it down the road. And even if they anticipate selling the property, they say to themselves, let's do the cost seg study today, and I'll worry about next year's tax liability next year. So I like to suggest 4 to 5 year hold, but ultimately, my clients know their tax and financial situation a lot better than I do.
So basically, if we will decide to sell it in 3 years, even though that we just bought it, it will be less beneficial than 5.
Correct. Look, here's the deal. If you sell it at a gain and like a nice gain, nobody cares, right? It'll be depreciation recapture, but it doesn't make a difference. If you sell it, even or then yes, then it's certainly something to be cognizant about, the depreciation recapture. And also, if you do a 1031 exchange, then there's no issue either because you're just going to have just a lower basis than replacement property.
Okay, makes sense.
Good question here from my end. We have some I don't know if there are attendees here today, but if somebody has a spouse that's a real estate professional, and they file taxes jointly, does that have any advantage there?
Again, one more time.
So like if if there's a high income earner and their spouse is a real estate professional and they file jointly, but they don't necessarily, the high income earner does not qualify for the accelerated depreciation because they're not a real estate professional, would they be able to work through their spouse's like tax
If the
return or
spouse
whatever?
does, again, if the spouse qualifies, but you have to, the rules are 750 hours over the year. It's got to be documented. But absolutely, that's what, I work with doctors, dentists, attorneys all across the country, business owners, and that's a pretty utilized play where, one spouse is the heavy wage earner, the high W-2, and then the other spouse is the real estate professional generating income tax losses. So again, but you gotta run that by your tax professional. I can't tell you how to do it, but that's certainly something that I've seen pretty often.
We're not trying to give any tax advices based on
Nothing.
that. No.
Roman, where do you live? Where's home for you?
New York.
New York. You're in New York right now?
Yeah, I'm in New York, in Bayside.
Oh, beautiful. Okay, we should meet for coffee one day. Take you to a nice kosher restaurant.
Where is you? You're in New Jersey, right?
I'm in Jersey, yeah, but I'm in New York all the time.
Okay, we can do that, and it will be great to meet you somewhere. If you want, Manhattan sounds good to me.
We could do that one day.
Yep, absolutely. All right.
Another quick question here for you. Actually, the one that we are doing together on 36008 East Market, what does it look like when we make, like on that specific deal, we're redoing the parking lot? So we purchased the building and we're completely going to redo the parking lot. It's like $20,000. What do you get to redepreciate that?
So great question. $20,000, in proportion to your purchase price isn't that high. Either your accountant will expense it, and again, I'm not giving you tax advice, or if they choose to capitalize it, then it should all be capitalized as a 15-year asset because that's what a parking lot is. And then if you capitalize it as a 15-year asset, then right again, you just jump right back into the 100% bonus and you'll pretty much wash that right away as well.
Got it.
And for the sake of other people understanding, what exactly 100% the
So
bonus?
part of the Trump tax code, originally that passed in 2017, any assets that are depreciated less than 20 years. So if it's 5-year property, 15-year property, you could pretty much expense it up front. That phased out 2023, 2024. And then when the Donald came back into office in 2025, effective January 20th, 2025, anything that closed after that is once again eligible for the 100% bonus depreciation. So purchase a property, again, you got to be the real estate professional, do the cost seg study, break it out into 5-year property, 15-year property, take the 100% bonus depreciation, and you can walk away with a very, very large real estate loss in the current tax year.
Basically, you're talking about paper loss. It doesn't really
Exactly.
matter.
Right.
Doesn't matter if you take it if you close on November or in January, right?
Correct. It's time value of money. It's a paper loss. It's a tax loss. But again, it's certainly helpful.
All right. Another quick question from me, because I'm taking too much time. If we will decide to give you property in Texas right now that we just acquired, and we can just set it up and basically start process, can it be done before end of the year so we can benefit from that?
So you don't need it done before the end of the year. So long as it's done before you file your tax returns, you're going to be good. Send me the property address, send me the purchase price, the closing date. I'll be more than happy to run numbers for you. At least that way you'll be able to share with your investors the tax depreciation that we have available. And then today's the 9th. I can't imagine I'll get it done for you before the end of the year. Possible. I don't want to say not, but we'll get it done for you, early 2026.
Okay, so that doesn't really matter because if we're not in a rush, if we want to do it the first year, total depreciation, 100% depreciation, as long as it's done before the taxes, right?
Correct.
And actually, Moshe, I already got you all the info. I think you already did the estimate for us. It was that 22 unit in Texarkana.
Oh, Texarkana. Yeah, sure.
So
Absolutely.
that's all right. That's about what, $5,000 plus minus.
Second, yeah.
Moshe, one question. The reason we started all this conversation, because we at the end of the year, we're like literally 3 weeks away from finally moving to 2026, right? I mean, I got it that we can do the study at the beginning of January 2026 and still applying for 2025. But the question is, how it's going to work with the investors. Like, for example, right now, we're looking to attract, 2 spots to investors or 1 investor. If they're going to get it, they got to apply their stuff on 2025. They got to get in the deal before the end of 2025, or it could happen like first week of 2026.
When's the deal going to close?
Yeah, we close it already.
Closed. You're just looking to fill capital. So confirm with your accountant. My understanding is that the deal closed in 2025. There'll still be 2025. You're gonna have to give them a K1 with income and expenses for 2025.
Yeah.
But
But they need to join the deal in 2025 or 2026.
I don't think so. I think even if they join in 2026, they're gonna be good to go. That's my understanding.
Before the taxes.
Before
Before
the
March
tax.
15, basically, before March 15.
Correct.
Oh,
Before you file your tax return.
that's interesting. I mean, we do have a couple of counters on our Zoom call. They can add something up. I believe it's Olga.
Yes, I don't agree. I don't think so. If what is it? It's gonna be transfer of capital, yes? So if new partner is joining in 2026, he's not gonna get K1 for 2025 because income gonna be prorated from the day partner came in. So if he's coming even now, he's receiving income only for particular. Again, is it transfer of capital? Or it's going to be like additional partner and we will like depending how we're going to treat him. But again, if he's going to enter into partnership in 2026, there is no way he's going to receive 2021 K1. It's going to be irrelevant for him. This is my understanding. Do you agree?
I could see that.
Yeah,
Well-
no, there is no way because he's entering partnership as a partner as a particular day. And the income will be allocated to him based on this amount of days. That's what we usually do. We have additional partners and there is transfer of capital or something like this. Income is prorated. And if it's going to be from 2026, no, this particular partner, he will not receive K1 for 2025 and no income or expenses will be allocated to him. That's how it works technically.
Got it.
Alright. Thank you for clarification. Oh, we have to see it again. No problem.
That was
At
like a little bit
At
common.
least, at least the question was asked, and that's the question that we need to answer anyway.
No, because I've been asked that question a few times. It's in my list, so don't take it for granted. I'm just, throwing all the questions I've been asked for like the past 2 weeks, So this kind of question been repeated like 4 times. Yeah,
Absolutely.
I keep record on questions, so
All
yeah.
right.
I mean, we got that part. We also got a couple people in our Zoom meeting. You have any questions? I'm talking about Vovi, Evgenia, Olga, Victoria. Any questions? Because you can ask something like personally related, whatever you guys doing.
Any text questions? Now's the time.
Yeah, now is the time. Yeah, correct.
You
That's the
don't
main
want to
thing why
hold.
we're here to ask the questions while we got that great professional Moshe with us and couple accountants as well.
Yeah, and he represents Medicine Spec. I'm sorry, I forget to mention that Medicine Spec is a company that we're working with. We had few successful deals with that company, and we like what they do.
I'm also looking to drive to 2 hours to join 2 of you for the coffee,
Okay.
and that kosher place.
No problem. Okay, people, please ask the question because we don't want to hold him.
Yeah, I don't want to hold anybody up.
No questions. Thanks.
What do we
Yeah.
got?
If you will have any follow-up questions, we can always address that.
Absolutely.
I will-
Thank you. Thank you. It was really informative. I do see a lot of tax returns and I see
Ah.
it's being, it takes time until usually filings on personal is not before and then deep into 26. And then business can go until September or September 15 would be the cutoff date for business filings.
Personal
So
takes you to October 15th.
October 15th. So there's a lot of time to work on those benefits, and it's very informative. Thank you. Appreciate it.
Absolutely. And your name's Volvi?
Volvi, yes.
Nice to meet you, Volvi.
Same here. I'm close by. I have the view out on Manhattan, so we're looking out for that coffee
No,
break.
we're getting a coffee party already.
That's
we should
it.
do it. Let's go.
I'll make the trip. Just let me know.
Absolutely. Very good, guys.
Very good.
Right.
Thank you
Sergio.
for your time, Marcio.
Thanks, friends.
Yeah, nice to see you all.
All right,
Well,
thank you.
bye-bye.
Bobby,
Thank you very
great
much.
to hear.
Bye.
Right. Okay, anyone else? If they have questions, no? If not, we can finish it up, right?
Yeah. Here, any questions? If you think of
I don't
anything
know,
afterwards.
I missed beginning of presentation. You were discussing what? Cost segregation, something else?
Yeah, no, not cost segregation specifically, just to be on the same page, so we will not talk differently to different people. And he is the one who is gonna be like guiding us, and I just want to be his voice and his advocate. But we just need to be more and more educated. And I know that you, Rita, basically know a lot about it, and most likely that you're right about 2025 versus 2026. That makes more sense than
Now, honestly, I was also surprised, but I'm not a professional here. So he's saying if he'll complete cost segregation in January, we still can claim it on return. This is, I don't know. This is like, I don't know.
verified. I'm not
But
denying
okay,
it.
this is, I can kind of possible. It's, I don't know, maybe it's possible. I don't know. I'm not saying not.
That's
But
right.
yeah,
At
but
least we have to verify that if it's a true
oh
statement.
no, it's what he's doing. He was pretty confident. I
No,
guess
it's possible because as soon
Yeah,
as you
yeah.
provide it to the tax professional for corporate return before it's done, it should be okay.
I believe
I
so
don't- yeah.
too. Yeah, I will report something like this. Yeah, okay.
Right, it's even more interesting then. But
Also, Victoria, are you with us?
please unmute.
All right. I mean, she had the question, You know, since it looks like, you know, people don't want to ask the question, so I'm gonna ask the question. They were asking me.
All right, no problem. As long as everyone happy with answers, we're all good.
Absolutely. I've been asked the questions like, for example, we do tax deduction, like for example, we offset like $25,000. Are they going to recapture at the end of the 5th year while we ascend the property, and what's the tax break is going to be?
No,
I can I can work with Moshe to do like a calculation based off of his estimate on a year like 5 or a year 7 sale and just kind of see what his estimate would be.
From our previous experience, that it does make sense if you hold in property for around 6 years. After that, all the tax benefits are void, and you will pay the same amount after if you hold in the property longer. So the question not to keep it longer. The question was what happens if you keep it shorter? How that's going to happen, and what you will be punished by IRS at the time of
But we
sale.
definitely can do projection when times comes. For example, if in 2 years you decide to sell the property, give me numbers. I will run projection. We'll see exactly.
Sounds good.
Not a problem. Yeah. So yeah, you're right. It's going to be depreciation, recapture all this stuff. But again, depending on again we're talking about, we can calculate, we can give numbers, and everyone will. Yeah, it's not an issue.
All right. Okay. We're doing good. All right. Thank you, everyone. Yeah, Wally, you want
Right.
to?
Thank you. It was
Thank
nice
you.
meeting
Bye,
you all
everyone.
and informative. Thank
Very
you,
nice to meet you,
Alex.
sir.
Right,
Thank you, guys.
I'll see you in New
Okay.
York.
Okay, have a good one. Thank
Let me know
you.
about the coffee break, guys.
Yeah. Bobby's coming too. He's in New York.
Okay, we met in Manhattan, Alex.
Yeah,
Already. That was our first meeting.
Yeah, that was 4 years ago.
Yes. Okay.
Very good,
No
guys. Thank
problem.
you.
Looking forward. Good luck.
All right. Take care.
Bye, everyone.
Bye-bye.
Thank you.
Bye.
Thank you.
All right. That's just us. Where
What's up, team?
did Roman go?
Roman left. But hey, I'm going to, here's what I'm gonna do, Alex. I'm gonna take this report that Moshe sent us.
Uh-huh.
I'm gonna put it into ChatGPT and I'm gonna tell it to estimate our recapture on a sale of each year and see what it looks like.
Yeah, I got it. I mean, based on how many LPs we got and GPs we got at the current moment.
I don't think that matters on recapture. It's just as a whole. It's like I mean, everybody would have their own separate amount based off their equity.
Yeah, I mean, we can do that too, you know, just to break down, because right now we're looking for, like, for example, right? We spoke before, we need like 50 or 100K, right?
Mm-hmm.
I mean, easily to break down because, like, for example, I'm talking to one person. I was like, okay, and they don't really care about the whole picture. Like, they only care about themselves. I mean, that's normal, you know. It's like, okay, why would I invest with you guys right now? Okay, I got 50K. What I can save right now? You know, I don't really want to throw them the whole picture, and then they still going to be asking those details. You know what I mean? I'd rather like go straight to the point. Okay, that's a 50K. That's example. That's what we got. We got X amount of people, 70, 30. Then we split that 70 between those whatever 5 people, you know, and it's 1, 2, 3 done. Instead of like less time to too much like to the waste of communication, I call it. Like, you know what I mean?
Mm-hmm.
I don't like. I'm not looking for 3, 4 more extra phone calls. You know?
No. Sergio just captures that recording and send it out. So we can either transfer.
Actually, you know what? We're still recording. Let me stop that.
Okay,
Okay.
that's nice.